All right, so let's get into it and say, well, why do you want to use a mechanical strategy? Let me get rid of this guy. So what I think one thing that I want to explain to people so they understand, I've been using mechanical strategies for many decades. Portfolio Strategy is a newsletter that I've published since for 28 years, since 1992. It's basically a portfolio of different mechanical strategies in many asset classes. Each of those strategies designed to improve the return and reduce the risk of the asset class and kind of determine whether it's hot or not, how much allocation we should have to it. And that total portfolio has never had a down year, never had a drawdown of double digits, and has made consistent annual returns in the high teens. And last year we had a very good year. We had a 4% maximum drawdown. I mean, that's a worse, under 4%, actually 3 something. That's very low in the most volatile year since 1929 in stock markets, and we had a 37.5% return. So mixing mechanical strategies is a really good way of making things really easy, really quick, and yet being able to get exposed to a lot of things and sort of reducing your overall drawdown. So I'm a big fan of mechanical strategies. I have some discretion in a lot of the things that I use, but I try to make them as mechanized as possible so that you can back test them, see that there's an edge, and see how to exploit that edge in a way that allows you to not have to get all emotional and destroy your objectivity. So a trading mechanical strategy puts rules in place, and your focus is on following the rules. That's it. That's what you're really focused on. That's what you consider success, following your rules. It reduces the mental capacity needed to trade well. It helps you make better trading decisions, because one of the things that happens to people is, money is a very emotional thing, and so people get, they tend to make their bad decisions at the time when it's really the most important, when things are really rough. And so mechanical strategy that has risk reductions galore in place is a really good way to make sure that you can follow things and exploit the situations that you need to. So it removes the emotions from decisions. And remember that most of the best trades happen when emotions are at their peak, and a lot of people have trouble if it's not a mechanical strategy. So, and the other thing that's nice about a mechanical strategy, you can computerize it. And in this strategy, for example, if you get one of our services in 5 to 10 minutes a day, you can manage your own portfolio and outperform the S&P over a long period of time. That's something that's fantastic benefit. So let's talk about some key beliefs behind this mechanical strategy. First of all, we're going to talk about the research behind this so you can really see it. But the returns that drive overall stock market performance usually come from a very small percentage of top performing stocks. Going to look at a lot of studies have gone back to 1905, 1928, somewhere in that time frame, and gone forward. And what they find is that each and every year, it's actually a really small percentage of stocks that are really, really outperforming substantially, that make up the bulk of gains in an average like the S&P, for example. And so one of the things that we're trying to do with this is key in on those really top performing stocks, because that's where we have the most bang for the buck, and that's where you get the outperformance. So we're going to try to identify and allocate our capital to 5 top performers in bull markets and 5 bottom performers in bear markets. Trading top relative strength names will lead you to outperformance in uptrends, and trading bottom relative strength stocks on the short side will lead you to outperformance on the downside. periodically rotating. So this is called, we call our things reads, and that's because what we're doing, it's just a name I came up with for strategies that don't stick to, we're not picking 5 names at the beginning of the year and you're just holding them all year. We are switching periodically to make sure that we're constantly in top names. And so that will rotating into top or bottom performers in bull and bear markets leads to outperformance. It reduces drawdowns during corrections against the main trend or trend changes. The ability to reduce exposure, so go to cash, go to short, change from being long to short, change from being short to long, in top relative strength stocks in the direction of the trend can cut drawdowns and lead you to continued gains despite whatever trend happens. Trading with the trend in both bull and bear markets can improve returns and substantially reduce drawdowns. So we'll look at it, but when you think about the S&P, for example, it's had 90% drawdown or something close to that in 1929, and several 50% plus drawdowns, 2009, 2007 to 9, for example. And so those drawdowns really hit your returns. So and then another thing we're going to talk about is that you want to trade with the trend and make sure the trend is at your back in any kind of trade that you're taking. And then another really important one that I want to get people to be thinking about and get the concept in their head is that the forces of supply and demand are what ultimately dictate prices and price trends in stock markets. And so in the US market, you have more tools for accurately determining what supply and demand are than any other market on earth or ever before. And so we're trying to put those things on your side to help you determine trends and help you determine when it's a good time to trade. And if you go further in our work, you'll see, well, our market timing stuff, for example, we have strategies based purely on that, but we can really drill down and help you a lot of times with determining really good times to trade. All right. Now we're also going to be filtering. So I designed this strategy, a long time ago, and then Chuck began watching it and really liked how it was performing, and we did some research, and he had a tool that he developed that based on some really good research, and it's which he calls WHAM relative strength. And so we've used that as a filter, and we've figured out that filtering the trades that we have historically based on that, basically it doesn't improve the returns, but it does improve the returns to risk significantly. And that's another thing I think it's really important for people to understand. We talk a lot about maximum drawdown and drawdowns and things like that. When you're looking at any strategy or methodology, you really basically want to determine what is the return that you get on average, and what is that compared to your maximum drawdown. So how much are you making on average, and how much risk are you ultimately taking at the worst possible time in order to garner those returns? And so any time you can improve that ratio, your average return to your drawdown, that actually improves the strategy. If you've lowered the return, you can actually beef up your leverage a little bit, and with the same, so that basically taking a little bit more risk, you can beef up the return to where you want, and you're going to still do it with a lower maximum drawdown. So looking at the average annual return to the maximum drawdown, really a key performance matrix that you're trying to optimize in any strategy.